Hi everyone, I'm Ashley Simpson, your host for today's webinar, Life Insurance for the Military Millennial. The presenters today are Mike Meese, Chief Operating Officer and Secretary here at AAFMAA, and Carlos Perez, our Assistant Secretary. Both are long-standing AAFMAA members and retirees from the United States Army, so they know the ins and outs and importance of life insurance. The presentation today is about 30 minutes long. At the end, Mike and Carlos will answer any questions from the audience. So since attendees of our webinars are muted, please type any comments or inquiries you have into the questions block on your screen at any time. Just know that we will wait until the end to address them. AAFMAA stands for American Armed Forces Mutual Aid Association and is the longest-standing not-for-profit association that empowers military families with affordable financial solutions. We accomplish this as the premier provider of affordable life insurance, expert investment management, customized residential mortgages, and our exclusive survivor assistance services, all for the military community, not for profit. This presentation is educational. It is for general information only and is not specific investment, legal, life insurance, or tax advice for anyone individually. Do not rely on this presentation alone to guide your life insurance decisions. Since each individual situation is unique, such decisions will not necessarily be the same for all service members. For individual advice, please contact us directly. We produce this webinar series in-house with our own professional staff as a service to our members to help them better understand the resources that are available to them. I will now go ahead and turn it over to Mike Meese, who will go over the agenda.
Thank you very much, Ashley. And as far as a little bit of truth in advertising, of the three of us here, Ashley's the only one who's actually a millennial. But Carlos and I have experience teaching and working with millennials. We'll be covering an overview of life insurance, the basics of what life insurance is, some of the conditions for service members who are in the service, and then talk about service members getting out of the service, and then some considerations for life insurance for our families. So first I'll turn it over to Carlos Perez, retired colonel from the Army, who earned his MBA from Stanford, taught economics at West Point to cadets there, taught lieutenant colonels and Navy captains at the Eisenhower Industrial College of the Armed Forces, served in Afghanistan and Buz and the Balkans, and was also an engineer battalion commander. So Carlos, please tell us a little bit about the basics of the challenges of life insurance.
Great. Thanks for that introduction, Mike, and welcome everybody to our webinar. We're glad you could join us today. Life insurance is one of three components of financial security. The other two being budgeting and saving or investing. And these three legs constitute a stool that provide us financial security, financial independence in the long run, and are all important. And so today we just wanted to talk a little bit about that first leg of that stool and explain to folks what it is that's challenging about it, how it works, and what some options available for our military millennial population might be. As you can see here, the perception regarding insurance is that it is very complex. We have terms like face values and death benefits and cash values and terms and whole life that really can confuse the buyer. And quite frankly, the industry itself hasn't done much to clarify how insurance works and what it is. In addition to that, a recent McKinsey study found that, number one, from an individual point of view, people find it tedious to research and to actually buy the products. And probably equally as important is that nobody really likes talking about these topics, such as illness or death, because we all don't want to come face to face with our mortality. But the fact is that we all do die, and life insurance provides a measure of protection and security down the road for our families. In the invitation to this webinar, we alluded to an insurance gap, and I thought we would quantify that a little bit for our audience today. So if you look across our country, this is a problem for a large number of Americans, and it kind of falls into two parts. First is the challenge of no coverage, and that is that more than 37 million American families just don't have it. That's over 10% of our population. It's about 11.5% of the American population that have no life insurance coverage. And then secondly, those that do tend to not have enough as measured in how long the proceeds of a policy might last and in the actual amount. So you can see there that on average, those that have insurance probably can cover expenses for about 3 years for the survivors, and nearly half of American households just don't have enough insurance by about $200,000. Now that gap is unique to every individual and every family. And what you have to do is, for your own personal circumstances, you have to try to determine what expenses and possible debts are out there that somebody might have to cover in your absence. And this slide shows some of the more common ones. We know that today as a group, millennials are getting married, they're buying houses, they're having children, and some of those children are going off to college. And so you see here what the implications of some of those activities are. And that first bullet up there is pretty important because that one is not optional. We all die someday, and somebody's going to have to cover the costs of that funeral expense or our final expenses. And so even if you have no other debt and you're fairly secure, you may still want to consider this for that reason alone. And the fact is that life insurance is critical to your financial security and your families if you don't want to burden a surviving spouse or any of your children with these kind of expenses when you pass away. So that's the problem and the challenge. I want to turn it over to Mike, and I'd like to just introduce him to our audience today. Mike is our Secretary and Chief Operating Officer. He's a retired Brigadier General in the Army with over 32 years of service. He has served as a professor and head of the Department of Social Sciences. His specialty is economics and national security. He's earned a master's degree and a PhD from Princeton. He's had operational experience in Iraq, Afghanistan, and Bosnia. And as such, he's been called upon to advise folks as a senior advisor, such as General Petraeus. And most recently, Mike served on the presidential transition team for President Trump as the Veterans Administration Agency Action Team lead, and then their landing team lead. So, Mike, over to you.
Great. Thank you very much, Carlos. Appreciate the introduction. And explaining what the problem is of life insurance, now to kind of give you Life Insurance 101. As in a nutshell, what life insurance does is it helps you manage risk. Everybody in the military is very good at doing risk assessment, and you know that when you have a risk, you try to avoid it, you try to mitigate it, you find some way to compensate for a risk that is out there. And life insurance is one of those ways of compensating for or addressing the risk of you dying, especially if you die prematurely. Now, there's other ways to manage that risk. Of course, wearing seatbelts, staying healthy, not drinking and driving, and those kinds of things are the ways to limit that risk. But there are inevitable accidents, health issues, diseases that can strike at any point. And so life insurance is a way for you to shift the risk of the income loss that would come to your family to a pool of other individuals, either as part of an insurance company or in the case of AAFMAA, we have about 90,000 members, and including their children and spouses, insuring a total of over 100,000 people who all share the risk. If anybody dies early, the premiums that you have paid and that anybody else has paid goes into compensating that other family for the risk that all of us collectively bear for each other. And Carlos described many of the expenses that are covered, which again differ for each individual, and within a particular individual, it differs during your phase of life. 20 and 30-year-olds are probably interested in making sure to provide for the income that they expect to have earned throughout their lifetime so that their families aren't destitute if they pass away early. They want to be able to leave funds for children's college tuition. Somebody in my age, and I'm in my 50s, all my kids are through with college, and so have very different needs. The concern for me is a house here in the Washington, D.C. area with a large mortgage, and that's a need for me. And that's why it's important that if you've not addressed your life insurance needs before, or if you have, it's important to update that every several years because your needs will change. To address the needs of different people, there's two basic types of life insurance, both term insurance and permanent insurance. We'll first describe term insurance. Term insurance, as the name implies, is for a fixed term of time. For example, you'd get insurance if you had a 30-year mortgage for 30 years to cover the term of that mortgage. In fact, people used to have term insurance. The expression in the West and Prairie community was, you've heard the expression that somebody bought the farm. Well, they would take out insurance to cover the price of their farm, and then when somebody died, the insurance would pay off that farm, hence the expression, when a farmer died, that he just bought the farm. Other people would have a term of time that when they're in the military, an extremely hazardous occupation, people might have life insurance for that time that they're in the military until their kids graduate from college or other time frames. Term insurance tends to be purchased by people who are generally younger, and they don't expect to die, nor does the insurance company expect them to die during that term of coverage, and that's why term insurance is relatively less expensive. It's the way to get the most amount of coverage for the least amount of money. Secondly, there's whole life insurance. Whole life insurance, as the name implies, provides coverage for your whole life. It's also known as permanent insurance and covers you all the way until you die. In that sense, it will pay out, assuming that you meet the obligations of paying the premiums in your contract, and so consequently, it is more expensive because the insurance company absolutely knows that they will have to pay the death benefit in the event of your death, and you know that they will pay that death benefit at the time that you die. The way that the whole life insurance works is you pay your premiums, generally a level premium for the entire period of payment, which can be 7 years, 20 years, 30 years, or for your entire life. That money goes into a pool that is invested by the insurance company to be able to build up cash value. And then if you die at any point prior to the, whenever you die at any point, the insurance company pays the entire death benefit. Well, you're paying your premium, the cash value continues to grow and grow and grow, and eventually at age 100, your cash value will have approximated the death benefit that has been promised to you. But nevertheless, throughout that entire time frame, the insurance company stands behind the ability to pay that death benefit to your family if you die all the way at any point before the policy completely matures. In that sense, this cash value is something that has other benefits. You can borrow against that cash value. Insurance companies have abilities for you to take loans against the cash value, and it can be used in some cases for long-term care settlements if you get into a situation needing long-term care. So there's other reasons to potentially have whole life insurance. And in general, for millennials, because whole life is more expensive, they'll get a smaller amount of whole life. And so it's not uncommon when we talk to millennial folks to have a larger, less expensive term plan, like $400,000, $600,000, or $800,000 to fill those gaps that Carlos talked about, and then having $10,000, $25,000, $50,000, or $100,000 of whole life insurance that provides the insurance that they expect to have for the rest of their lives. Also, when we look at insurance, there's other kinds of considerations. You may hear of other types of life insurance, such as universal life insurance, which was very popular, especially when interest rates were higher. Universal life is both provides life insurance as well as invests some of the money. It allows you to have flexible premiums and flexible benefits, and is particularly useful when interest rates are high. It's frankly less popular now because interest rates are low, and many times as we see people who got universal life several years ago, it's sometimes problematic today because the interest rates are lower, and they're realizing as they get into their 60s or 70s that they either have to pay more in the premium or have to substantially reduce the death benefit. In general, my expression is don't buy anything that you don't understand, making sure that you read and understand the fine print. Here at AAFMAA, for example, we don't do universal life. It's usually much easier to understand the term and the whole life policies, and you can get what you need in almost all cases with that kind of insurance. Also, with both AAFMAA's policies and other policies, you can get advanced settlement, which the IRS allows you to do. Either if you get into a situation where you have a terminal illness, you can carry forward an accelerated death benefit, or if you have a long-term care need, you may be able to get your long-term, insurance death benefit paid to you tax-free during your lifetime if you meet certain criteria specified by the Internal Revenue Service. It's important to look at your policies and compare policies to see what benefits they provide. Additionally, associations like ours provide embedded services. One of the exclusive things that AAFMAA does that, frankly, we haven't found any other organization does, we have an entire team of survivor assistance service specialists that take care of the widows or widowers and families of service members who die to help them ensure that they get all the benefits necessary from the VA, from the Survivor Benefit Plan, from Social Security, and others, kind of wrapping around the family at their greatest time of need to be able to take care of all of their needs. Finally, it's important to look at whatever company you're considering to see how long have they been around, what their ratings are. As we note on here, 3 years ago, we celebrated our 135th anniversary, and AAFMAA, we've been here for 138 years, and we plan to be around for at least the next 138 years. Now, looking specifically at the needs of life insurance for military members, anybody who's currently in the military, it's important to see what they already get from the Army, Navy, Air Force, or Marine Corps. Anybody who dies on active duty, and this is separate and in addition to any life insurance that they may have, gets a $100,000 death gratuity, VA assistance for burial and some of the final expenses, and then their family gets what's known as dependents indemnity compensation, which is a little bit more than $1,200 for your spouse and $300 for each child. Plus, when children turn 18, the $312 per month ends, but if they're in college, they can get dependents educational assistance for up to 45 months. Now, that about $2,000 a month for a widow and 2 children is probably not enough to live on, and that's why service members supplement what they would get from the military with insurance, and we'll talk about that. The first way that every service member is enrolled in is what's known as the Service Members Group Life Insurance, or SGLI. Some people don't even realize that on day one in the military they signed you up for this, and when you look at your limited earnings statement, there's normally a deduction that says SGLI, and it's normally $28 or $29 on your LES, and that provides $400,000 of term insurance for as long as you happen to be in the military. That's in addition to the death gratuity. Some people don't even realize that if you did not want that or didn't think that you needed that much insurance, you could reduce the insurance or decline it altogether. An important consideration is both the death gratuity that I talked about and the DIC that I talked about on the previous slide, as well as SGLI, both of those end when you leave the service. So most people find that there is a need both to supplement SGLI as well as to have something that takes over when they leave the service. That's why among the things that we did within AAFMAA is to develop what we call level term 1 insurance. This provides insurance that's very, very similar to SGLI with 2 exceptions. First, as you can see from the numbers in red, it happens to be less expensive. Instead of paying $28 per month, which is the cost of $400,000 for SGLI, it's only $18.15 for AAFMAA's level term 1 insurance. The second difference is that the AAFMAA insurance stays with you after you leave the service. So when the death gratuity and DIC are gone, you still have this insurance. It's not uncommon if a service member has a spouse and, say, 2 children, the $400,000 would not cover the gap that Carlos talked about earlier. It's important to get at least another $400,000 and sometimes as much as $800,000 to cover it. Again, that gap and how you cover it is entirely up to you. You can certainly use AAFMAA, or as we note at the bottom of the slide, check with other carriers, SelectQuote, USAA, and others that are great, credible organizations that can also provide term insurance. The important thing is for you to address the risk that your family faces. That risk sometimes increases as you leave the service, and I'll turn it over to Carlos to talk about insurance considerations when you get out.
Thank you, Mike. As everybody knows, we all leave the service someday. And if you have an insurance gap, you need to probably replace that SGLI policy with something. Well, one of the things that's offered to service members when they leave is Veterans Group Life Insurance. And you can see on this slide that VGLI has some very similar features as compared to SGLI. You can get coverage up to $400,000 in $10,000 increments. It is a temporary policy and it's renewable at 5-year intervals. A key part of VGLI, or a pretty important feature, is that red bullet, which is that no proof of medical insurability is required if you opt into the program within 240 days of separation. I'm going to come back to why that's important. But you have a year and 120 days to decide if you want this. So VGLI, similar coverage to SGLI, option to everybody that leaves the service. But what you'll see is, next slide please, VGLI, when you look at the premiums, can be expensive. So at the top of this slide, you see what soldier service member pays for SGLI. If you were to replace that $400,000 SGLI coverage with VGLI, every 5 years, your monthly premiums would increase, starting at about $68 in your 40s to as high as $1,800 when you're in your 70s. And there's a reason for this. The reason goes back to that red bullet, and that is that unlike other policies, VGLI has to accept everybody that applies or opts in within the eligibility period. And what this means is that it has to accept both healthy and non-healthy alike. So whereas you may be a 20 or 30-something young, healthy person opting in, somebody else might be older and have health issues and maybe is a smoker. All of those things incur higher risk on the insurance company, and they pass that along in the form of higher premiums to that pool of people in the program. So what's the takeaway? Let's look at the next slide. This slide shows some comparable premiums for a $400,000 policy for 20 years. At the far left column, you see age brackets. Then you see what the premium would be for VGLI in that age bracket. Then you see from Super Select to Class 2, monthly rates from AAFMAA depending on your health and how your underwriting outcome is. Most of our folks fall into the Select category there. And then the far right column is a peer company's rates for a monthly insurance premium for that same policy. And what you see, if we just use that Select category as an example, in every case, that premium is a better premium than VGLI. And after your mid-50s, you can see that even our peer company there, the comparison company, is also better. So again, the reason for this is that VGLI accepts everybody, and what this means is that if you are generally in average or better health, it's worth shopping around before you opt into VGLI. That's the main takeaway for this. Now, some folks, if you stay to retirement, can also opt for survivor benefit program. And the survivor benefit program is a program where you can pay a portion of your retired salary, your retired benefit, up to 6.5% of it. And in return, the program will provide your surviving spouse 55% of your retired pay. So the real question is, and I have an example worked out here at the bottom for a sergeant major with 30 years of service, but the question is it worth me forfeiting a portion of my retired pay so that my spouse, and only my spouse, can get some benefit if I pass away in retirement? If you go to the next slide, what you'll see here are some of the pros and cons of SBP versus a regular insurance policy, which is the alternative that most people consider in lieu of a survivor benefit program. So SBP provides you provides your spouse or your survivor a lifetime monthly benefit that's adjusted for cost of living. Pretty powerful. It's also pre-tax premiums, and age and health and lifestyle don't factor in. On the other hand, unlike insurance, SBP has one beneficiary, and that's your spouse. In contrast, with insurance, you can change your beneficiaries at any time, but those policies tend to be fixed and not COLA adjusted. You don't get the tax breaks on the premiums, and they're subject to underwriting. So the lesson here is you have to look closely at your particular circumstances, but in general, the longer that you believe your spouse may survive you, the better survivor benefit program looks from a financial perspective, because the longer that is, the more likely it is that your survivor would go through the proceeds of a life insurance policy. And if you wanted to work out some detailed numbers, our advisors here, our insurance advisors, can help you with those calculations. But as a rule of thumb, the longer your spouse survives, the more appealing SBP becomes. So speaking about spouses, I'm going to turn it back over to Mike, who's going to talk a little bit about insuring your spouses and your children.
Great. I've just got 2 slides left before we wrap up and get to questions. So if you do have any questions, and I see some coming in there, just go ahead and enter those in the question block, and we'll address any questions that you have. People often ask, well, I'm the primary breadwinner, and I'm not very dependent upon the income that my spouse may be bringing in. Should I insure him or her? And the answer probably is yes, if you're dependent upon the other kinds of things that they provide. In my case, I was in the Army for 32 years. My wife worked a bit outside the home in the Army Education Center, but much of the time she was taking care of our children, and the risk, if she were to die prematurely, is that I might have to leave the Army, might not be able to continue with my income, and certainly would have significant expenses of being able to take care of children and a household and those kinds of things. So throughout the time period when I estimated what that would be, we had, when my children were young, a $350,000 relatively inexpensive term policy to cover the unexpected death and the income loss that I would need to recover from. As I joke with my wife, the purpose of the $350,000 was not so that I could go get a Corvette so I could look cool and find a new wife, but was to be able to cover those sorts of expenses that I would otherwise have to come up with. In order to do that, one option for those people that are still on active duty while they are on active duty is to have the Family Survivors Group Life Insurance, which you can get for $100,000, and that comes out of your LES. The maximum of that is $100,000, and again, unfortunately, it ends when you leave the service, just like SGLI does. Or you can go with our relatively inexpensive level term 1 rates for whatever the amount would be that would be the gap that would have to be covered. The other aspect of a family is taking a look at whether or not to get insurance for children. Again, there's very few chances that any family is dependent upon a child's income, and so consequently there's not a huge need for term insurance for children. And in fact, one benefit of both SGLI and Level Term 1 is that they cover military dependents, children under the age of 18 or under the age of 23 if they're in college, with $10,000 of insurance automatically. And that can cover the expenses of an untimely death of a child. However, people do sometimes get insurance for a child when they're young, primarily because children are more healthy, and consequently it's easier to get very low-cost insurance for them. We have a couple of examples there of $6.20 to cover a 5-year-old with a $10,000 policy in what we call our Generations Plus policy, which is very similar to, if you've seen the commercials on TV for the Gerber Life policy. The advantage of this is it doubles when the child turns 18, and it allows the child to purchase at standard rates up to $100,000 worth of insurance, 10 times the original amount of insurance that was purchased. The advantage of this, of course, is if the child gets sick, gets juvenile diabetes, or any other kinds of diseases that children may get and would otherwise be uninsurable, this guarantees that they're able to purchase insurance at standard rates when they get older. Another option, which actually that's my grandson that's there, the son of my daughter and a soldier in the 2nd Battalion 75th Ranger Regiment, I got a $50,000 whole life policy, and since he was very young at the time, it was less than $38 a month, I'll pay that for the next 7 years, and at the end of 7 years, he'll have a fully paid up $50,000 policy that'll last him the rest of his life. Again, he doesn't even know what that is right now, but when he's in his 20s and sees the advantage of that it's building up cash value, he could take a loan against it if he needed the cash. He could certainly cash that in and be able to use that for whatever he needed, or just have that base that was able to be purchased for him by his very generous grandfather, hopefully he'll think, at very low cost. So with that, why don't we turn to the questions and see what questions have come in.
Great. Okay. So the first question comes from a 25-year-old single, 02, who says, should I get life insurance now, or should I wait until I separate, which may or may not be in the near future?
That's a great question. What I would recommend for anybody considering this is start out by looking at whether you have that insurance gap we spoke about earlier, because that's really the central question is, do you have a shortfall in coverage? If you have one already today, even with SGLI, then I would absolutely recommend looking at and purchasing some insurance to bridge that gap. But even if you don't have a gap, there is potential value in researching and buying a policy now, and that is that premiums, one of the things that they depend upon is age and health. And the younger you are, typically the healthier you are, so the lower your premiums would be. So if you think you may be getting out soon and you know you need to replace SGLI, I would encourage you to start immediately in terms of looking for a replacement.
Okay, great. So the next question, what about hybrid long-term care insurance, which is a long-term care policy coupled with a whole life insurance and therefore offers a return of premium if long-term care is not needed?
It's a good question. And the way we don't do what's known as what the person described there as a hybrid policy. What we do is we include at no additional cost a long-term care settlement option with all of our whole life policies. If you have a whole life policy from AAFMAA, and you can look on our website for the details, a straight whole life policy, we have an annuity life policy, or as I described, for the you can get it as for a child, a Generations Plus policy. If you're over age 60 and you get into a circumstance where you need long-term care, you can draw on that insurance. A doctor has to certify that you cannot accomplish 2 of the 6 activities of daily living. And so let's say you have a $100,000 life insurance policy. We will pay that to you at 2% of the face value of the policy, not your cash value, but the total death benefit, 2% per month for the next 50 months. So you'll get 100% of your death benefit payment, but it's spaced out over the next 50 months. The IRS, normally you couldn't take the cash value out of your policy without paying taxes on it, but the IRS says that if a doctor certifies that you can't do 2 of the 6 activities of daily living, then you can get the long-term care payment tax-free. And so that's how that works. Most people who get into a long-term situation where they need long-term care, for a male, they generally die after about 26 months. Females die after about 30 or 31 months. And that's why we specified 2% per month for 50 months. The huge advantage of having a long-term care settlement option on a life insurance policy is that if you don't use it, it's not just a return of premium. That's an entire life insurance policy, which then goes to your heirs. By the same token, if you die after 26 months, in this case that I had with $100,000, we will have paid out $52,000, and the remaining $48,000 goes to whoever your beneficiaries are. So it's different specifically from the hybrid policies with the return of premium, but we think that it's a better and simpler way of doing things. From our perspective, if you're in a situation where you need long-term care, the probability is we're going to pay out the death benefit anyway. Just if you can comply with the IRS rules, we'll pay it out to you while you're still alive. And finally, when we do start paying it out, of course, your premiums stop on any of those policies.
Great. Thanks, Mike. So the next question is, with the Generations Plus policy, does the child insured have to pay for the policy once they turn 18, or can the parent continue to pay premiums?
That's a great question. And the answer is the child does not have to pay for his or her policy. The parent can continue to pay, the owner can continue to pay, or if you want to, the child can pay. But there really is great flexibility in who pays. The key is that the premiums are paid so that the policy stays active. And we have seen all of the above with our members here at AAFMAA. So a lot of flexibility in who pays.
Yeah, in general, what we'll do, what often happens, at age 18 or age 21, we recommend that the ownership transfer to the child, just like that policy that I mentioned for my grandson. I'm paying for the policy, but I have my daughter being the owner of that policy. That way she controls it, she can cash it in, she can do whatever she wants with it in terms of managing beneficiaries. But the key is just continuing to pay the premiums for that policy.
Another question we have is, why would anyone get VGLI at all if it's so expensive?
Thanks, Ashley. I'll take that. That's another good question about VGLI because, as I mentioned, it does have some benefits and it may make sense for some people. I think there are two reasons why you may take VGLI. The first one, quite honestly, is that many people just don't realize how expensive it is. Myself and I have several friends, when they were leaving the service, we really didn't know that those premiums were expensive until we started shopping around. So the first category of people that buy those just simply didn't become well informed and made a decision just based on something that was offered to them that was convenient. But the second reason goes back to health. You may want to find other policies that may be less expensive, but if you have significant health issues, you may not be insurable. And so if you have an insurance gap and you know you need coverage and you're declined for coverage by an insurance company, VGLI still allows you a way to cover that insurance gap for your family, and so it could make sense for you to do, even though it's more expensive.
Great. Okay, and looks like we have one last question. As a single, never been married individual with a decent-sized estate, regardless of age, is it worth getting life insurance at all?
Well, again, each individual, it goes back to what Carlos said at the beginning. You have to assess what are the gaps and what are the needs that you have. In the circumstances there, it sounds like nobody is dependent upon this person's income, and so therefore there's not a huge need to be able to provide income for your family. On the other hand, if the person had debts, you certainly would want to cover those debts and not have your estate settled with all of those debts that you might have. And even if you, and especially if you had an estate with a house, cars to get rid of, and those sorts of things, somebody is going to have to become the executive of your estate, whether that's your parents or your brother or sister or a good friend or somebody like that. And although that would be certainly an administrative burden and probably an emotional burden for them, you would not want to also make that be a financial burden for them. And so that's why individuals in that case having purchasing now, especially if you have the funds to be able to do it, $50,000 or $100,000 of permanent insurance that would cover you and those kinds of final expenses at the time of death would be particularly important. Another reason in this particular case, some people who have very large estates, and again, this doesn't usually apply to military millennials, but hopefully you would aspire to being in the position where it could, is individuals who have a lot of net worth will have large life insurance policies because life insurance passes to the beneficiaries outside the estate and directly to those beneficiaries, and it also passes to them tax-free. So that if an individual has a lot of money that is, a lot of their wealth that is stored up in property or art or gold or other kinds of things, vintage wines or vintage cars that would be hard to get rid of to be able to pay the taxes, that the life insurance proceeds would be able to be used to be able to facilitate not only final expenses, but sometimes the tax bills, so that the heirs of that super rich person wouldn't have to liquidate their estate just to pay the tax bill that would take place.
Great. Those were some great questions. So thank you so much, Mike and Carlos. If we didn't fully answer your question, or if you can think of another question, please reach out to us at membership@AAFMAA.com. We'll go ahead and break here for now, but you can reach us whenever you need to. Please, again, never hesitate to reach out to anyone over here for assistance. We do this every day for our military community, and it is our pleasure. This weekend, you'll receive a follow-up email with instructions on how to access a recording of this presentation. And you can always register for future webinars and review past ones at AAFMAA.com/webinars. And speaking of future webinars, be sure to join AAFMAA Wealth Management and Trust on March 9th for their next webinar. We will announce the topic in an email invitation coming to you in the next few days. If you found this information useful, please share it with your friends and family. Our membership grows stronger every year because you introduce those in your military community to us. Thanks again for joining us today, and we look forward to assist you in the future.